Hello everyone, welcome back to my channel, Fiscal Fighter. I'm thrilled to dive into a fascinating topic today that bridges the world of mathematics and stock market predictions. Have you ever wondered how those complex mathematical concepts you learned in school could help you understand forecasting stock movements? Get ready to find out how. Here on this video, we'll be exploring the power of standard deviations. We will also dive deeper into how they can be used to provide valuable insight into the probable future risks and profitability of a stock. So, buckle up and get ready to embark on an eye-opening journey where math meets finance. Don't forget to hit that like button, subscribe to my channel, and ring the notification bell so you never miss out on our exciting math and finance explorations. Alright, let's dive into the world of numbers and stocks. Thanks for tuning in, and let's get started. I'll break down this seemingly complex concept into bite-sized pieces and show you how to apply it to real-world trading scenarios. In which first, we will understand what is standard deviation, and then we will apply the concept of standard deviation on two sample company A and B to understand it in better way. Standard deviation is a measure of how diverse or scattered data points are in a data set. It helps us understand how much individual values differ from the average. You can see the equation for finding the standard deviation on your screen. To get the standard deviation, you need to follow a few steps. First, you find the average of the data. Then, you subtract the mean from each data point and square the result. After that, find the average of the squared differences, which gives you the variance. Finally, take the square root of the variance to get the standard deviation. In basic terms, standard deviation tells you how much the data points vary from the average. It gives you an idea of the overall range of the data set. It is very challenging to understand only from this information, but I assure you that you will get a better grasp of this topic if you watch the video till the end. Let us take an example of companies A and B, and this is in last 5 years imaginary data about their annual return. We will compute the standard deviation for both data sets. And then we will conclude that which company has higher risk and which company has lower risk associated with investments. If we look at the company A data, we can easily derive the average annual return over the last 5 years, which is simply the total of all annual returns divided by the number of years, which is 5. So the average annual return over 5 years is 9.60%. After deriving an average annual return, we will deduct the average value from each of the data, which is called as deviations. After that, we will square each deviation's value as shown in the table. Then, we will total the squared deviation values and derive the average squared deviation value. The average of squared deviation values is called as variance, which is 0.006424 in our case. Lastly, the square root of variance is called as standard deviation. The value we derived for standard deviation is 0.0801. So for company A, the average return over the past 5 years was 9.6%, with a standard deviation of approximately 0.8015. From the result, we can tell that company A can expect to give a return of average annual return, which was 9.60% plus or minus 8%. If we calculate the standard deviation for company B, we will derive that company B will expect to give a return of 8.20% plus or minus 2.57%. Based on this analysis, you can see that company A has a higher standard deviation, which shows that the expected return is higher but the risk associated with it is also higher. Company B has a lower standard deviation, which shows that the expected return is lower but offers more stability. This helps you assess the trade-off between potential returns and risk. If we think about making investment decisions, if you have a higher risk tolerance and are comfortable with larger fluctuations in your investment value, you might consider investing in company A. On the other hand, if you prefer a more stable investment with lower risk, company B might be a better choice. Thank you for watching the video. Feel free to like, comment and subscribe to my channel Fiscal Fighter.